Welcome back to Investing Talk Podcast. Today we are focusing our attention on the global pharmaceutical giant, GSK. The central question we're tackling for you, our listener, is pretty simple. Is GSK a good time to buy now? I mean, the company's been incredibly busy lately, hasn't it? Lots of big strategic moves announced. So we need to kind of synthesize all the source material we've got and figure out what it really means for the stock.
That's right. Yeah, the narrative for GSK right now, it's all about aggressive action, especially when you think about the long-term risks they face. So to answer your question, we really need to look at, I think, three critical things. First, just the sheer scale of their recent commitments, both strategic and financial, the momentum they've built up. Second, we need to look at the fundamentals. Are they strong? What competitive advantages give them the flexibility to make these huge bets? And finally, we'll analyze the near-term technical picture. What are the immediate catalysts kicking around that could push the stock?
Right, that sounds like a solid plan. That should give us a complete picture. And hey, if you want us to look into a specific company next time, please do leave a comment below. And while you're there, don't forget to subscribe, like, and comment. It really helps support the work we do. Okay then, let's unpack this massive strategic shift. The news flow has been pretty relentless, but I guess we have to start with the biggest commitment they've made, the one that sort of drives the whole investment thesis right now.
Yeah, definitely. And what's fascinating here is just the scale of their ambition in the U.S. GSK, committed to investing at least $30 billion in U.S. R&D and manufacturing. And that's over the next 5 years. This isn't just, routine spending. It feels like a real strategic pivot. They want to deepen their footprint in the biggest pharma market globally.
30 billion. That number is, well, it's staggering. What does that money actually go toward? Is it just vague R&D or?
No, it's actually highly specific. A big chunk, for example, $1.2 billion is earmarked for a next-gen biologics facility. This is really about building capacity for their future pipeline, using advanced manufacturing, and crucially, integrating AI into their research.
Yeah.
The idea is to speed up drug discovery, optimize trials. It's a pretty aggressive, forward-looking investment. They want to cut the time it takes to get those high-margin specialty medicines to market.
Okay, building a future pipeline makes sense. But shareholders, they also care about immediate returns, right?
Right.
And this is where it gets really interesting on the financial side, capital allocation. Because despite this huge investment plan, they seem to be signaling a lot of confidence through capital returns right now.
Absolutely. That's a key point. The sources definitely highlight active share buybacks are ongoing. Treasury holdings, I saw, recently hit 247.5 million shares. That's over 6% of voting rights. And to put a number on it, they spent over $822 million just in the first half of this year. That's part of the existing £2 billion buyback program. Yeah, it's a strong signal. Management clearly thinks the stock is undervalued, even while they're undertaking this, colossal investment.
And that confidence, it seems to translate directly into the pipeline moves we saw recently, too. Can you walk us through those acquisitions back in August?
Certainly. Yeah, that period seemed focused on plugging some specific high-potential gaps in their portfolio. They completed the Boston Pharmaceuticals acquisition. That specifically brings in a drug called efmosfermin, and that targets MASH, which is metabolic dysfunction-associated steatohepatitis. Bit of a mouthful.
Okay, MASH. For those of us not deep in hepatology, why is that important? Why is this acquisition strategic?
Well, it's critical because MASH is basically the clinical name for severe fatty liver disease. It can lead to cirrhosis, and it's becoming a huge global health issue. Right now, there aren't many great treatment options, and the potential market for effective MASH drugs is projected to be enormous. So integrating efmosfermin gives them a potential best-in-class drug in a massive white space market.
Got it. And beyond MASH, they also did a deal in respiratory health, correct?
Yes. The other major move was the strategic collaboration with Hungary Pharma. This deal covers developing up to 12 different medicines. That includes a leading PDE34 inhibitor for COPD, chronic obstructive pulmonary disease. So this collaboration really broadens their late-stage pipeline across oncology, respiratory, and immunology. It kind of balances that MAS bet with their established expertise in respiratory.
Okay, so all that aggressive activity, it clearly paid off in strong financial performance, which I guess gives them the credibility to announce that huge spending plan. Back in July, GSK revised its guidance up pretty sharply, didn't they?
They did. They revised their 2025 full-year guidance toward the top end of what they previously expected. The forecast now suggests, I think it's 3-5% turnover growth and 6-8% core operating profit and EPS growth. That's at constant rates. And that's not soft growth, That's pretty robust, especially in the complex pharma world.
And what was driving that momentum specifically?
It was heavily driven by double-digit sales growth in their specialty medicines division. That includes their focus areas like oncology, HIV, and respiratory. It's really evidence that their strategy, shifting towards these high-margin specialty treatments, is actually working. Seems like they're delivering on pipeline milestones, too, with 16 assets now in late-stage development, the engine's firing. And if we connect this to the bigger picture, I mean, the reason they can afford this massive strategic push is that the financial foundation seems demonstrably solid. Looking at the 2024 financials, total revenues hit $31.6 billion. Operating profit came in at £7.6 billion. Pretty healthy numbers.
And the number that really stands out, especially when you compare them to peers, is that operating margin around 24%.
Yeah.
Why is that margin advantage so significant, especially for a company planning a $30 billion project?
Yeah, that 24% margin is crucial. It's significantly above the large cap pharma peer median, which is what, hovering around 18%?
Right.
So that's a 6 percentage point cushion compared to the average large pharma company. And that advantage translates directly into, well, two things. Serious financial firepower for that R&D investment we talked about, and also greater insulation against, the inherent volatility of drug trials, economic cycles, maybe product setbacks. They can risk more because they have that operating cushion.
That makes perfect sense. Okay, so they have the operating cushion, they have the cash flow. Let's do the financial health check. Are they taking on too much debt given the spending plans?
Doesn't look like it. Leverage seems moderate. The net debt to EBITDA ratio is at 1.95x. That's very manageable, actually below the industry average. And furthermore, free cash flow is improving quite dramatically. It reached $4.4 billion in 2024, up from about $3.8 billion the year before. That shows really excellent cash conversion, even with all the intense R&D investment. They seem to be funding the future without compromising today's stability.
So what are the core competitive advantages then? Things that make these financials stable and repeatable, whatever the economy is doing.
Well, GSK is positioned as a top 5 global pharma and vaccines company. That scale helps. Key competitive pillars include its really entrenched leading positions in immunizations. That's primarily driven by blockbusters like Shingrix. And they also have that strong established presence in respiratory specialty medicines.
Tell us a bit more about Shingrix. That product always seems to dominate the revenue discussions. How resilient is its position, really?
Shingrix provides a real structural advantage. It's a clear market leader in adult vaccines. And that segment often faces less intense competitive pressure than, say, traditional small molecule drugs. The advantages come from the specialized manufacturing needed for vaccines, the long cycle times for competitors to even try to catch up. So this dominance in immunizations, backed by their established R&D scale, spending over $5 billion annually, it makes their revenue stream pretty durable.
Okay. Now let's pivot back to that central tension we identified earlier. No pharma company is risk-free, right? And this whole narrative is built on aggressive execution. What's the big threat here?
The trade-off is clear, yeah. Despite these robust fundamentals and the strong margin, the sources all flag the elephant in the room: patent expiries. Coming late in the decade, GSK is still heavily reliant on a few blockbuster products, which means execution in that late-stage pipeline, especially the assets funded by that $30 billion, becomes absolutely critical. They're basically running a high-stakes race against the clock on their current revenue streams. The investment has to yield results, and relatively quickly, to avoid some serious future revenue erosion.
Okay, let's transition then to the current stock environment, the tactical picture. The question for you, the listener, is, given this massive strategic gamble, the underlying strength, but also that risk, how is the market actually valuing GSK right now? As of September 23rd, 2025, the stock's trading around $40.52. What's the technical analysis telling us about investor conviction, or lack thereof?
Well, the technical picture really shows the market is kind of pausing, taking a breath. The stock's in a clear consolidation phase. It reflects that indecision about whether all this recent news justifies a breakout yet. Technically, it found pretty solid support between, say, $38 and $39.50, and it keeps running into resistance up around the $42 to $44 level.
And the momentum indicators. We often hear about RSI and MASD. What are they saying?
Right now, they're pretty neutral. The relative strength index, the RSI, it's sitting around 54, and the MACD indicator is basically flat. For the non-technical investor, that just means there's no clear directional conviction right now. There isn't strong upward momentum signaling an immediate breakout.
But no major weakness either.
Exactly. No weakness signaling an imminent fall. It really feels like it's just waiting for a trigger.
Which tells us that the next 3 months or so are packed with potential catalysts. Things that could either validate this holding pattern or, push it out of that range.
Yep. Precisely. We've got a couple of major dates to keep an eye on. The really key date is the Q3 2025 earnings release that's coming up on October 30th. That release will be crucial. It absolutely must confirm that core operating profit and EPS are tracking towards the upper end of that revised guidance we talked about.
Yeah.
Any slip up there, the market will likely punish it immediately.
Okay, so earnings first, and the second catalyst is more pipeline data.
Yes. We also need to watch for the US and EU medical conference presentations scheduled for December 9th. These conferences are often where pharma companies unveil key late-stage clinical data. So a positive readout for one of their advanced oncology or respiratory assets, that could be a significant share price catalyst.
And the flip side?
Well, conversely, a negative result would obviously raise major concerns about that execution risk we just discussed. It would hit sentiment hard.
Right. What about the industry chatter? The rumors always kicking around. Any whispers about potential deals or big capital actions that could trigger a move?
Yeah, there are always rumors. The ones circulating now mostly seem to revolve around leveraging that new U.S. infrastructure push and their strong cash position. First, there's market speculation about a potential strategic U.S. oncology partnership. That massive $30 billion investment makes them a potentially very attractive partner, right? Especially for smaller biotech firms needing manufacturing scale or distribution reach.
That makes strategic sense. What about capital returns? Any more action there?
That leads to the second rumor, the dividend upside whisper. The thinking is, if Q4 cash flows prove exceptionally strong, there's some chatter about a possible special dividend, or maybe an accelerated capital return program even beyond the current buyback. Given their high margins, it's plausible.
Interesting. And finally, M&A. Always a possibility in pharma.
Yes. The third rumor suggests maybe accelerated M&A in immunology. Specifically, the whispers seem to indicate GSK might look for another targeted acquisition, perhaps in the immunology or respiratory subsector, maybe before year-end, just to further shore up that pipeline against those patent risks down the road. So this all raises the important question, doesn't it? Given the momentum, the strengths, that looming patent clock, the flat technicals, where does the overall investment stand right now? Our analysis, looking at everything, gives GSK an overall rating of about 6.5 out of 10.
6.5. Okay, that's sort of lukewarm, isn't it? It signals potential, sure, but also caution. What would need to happen for that rating to move up? To say an 8 out of 10, buy. And what keeps it from falling below a 5, maybe?
That's exactly the right question. To hit an 8, I think we'd need two things. First, a confirmed, really strong Q3 earnings report, pushing them clearly past the top end of guidance. And second, a confirmed positive Phase 3 readout for one of their major late-stage assets in December. That combination would really prove the execution engine is working.
And the floor. What stops it dropping lower?
What keeps it from falling below a 5 really is the underlying stability. That comes from the vaccine business, the Shingrix revenue stream, and that sector-leading 24% operating margin. That provides a pretty robust floor, financially speaking.
Okay, so let's try and summarize the thesis then for you, the listener. Let's quickly wrap up these core trade-offs.
Right. The strengths are pretty undeniable. You've got robust earnings growth, that absolute dominance in the vaccine market with Shingrix, and, of course, the highly credible, financially backed $30 billion U.S. investment program. That signals real commitment to long-term growth.
But those weaknesses, they definitely temper the enthusiasm. We keep coming back to the same couple of points.
No, the weaknesses are primarily those looming patent cliffs late in the decade. They are losing protection on several key revenue drivers. And secondly, the significant execution risk tied to that incredibly large, complex $30 billion investment. I mean, building world-class biologics facilities, integrating AI seamlessly. It's difficult, it's expensive, and it's definitely prone to delays.
So the conclusion on timing then. Is this an opportunity for a quick profit based on these near-term catalysts, or does it really require commitment?
Well, based on the current neutral technicals and the valuation, GSK isn't really a deep value play right now, nor is it a true momentum outlier. So the recommended investment horizon is long term. Look, this stock offers stability and attractive yield, and the growth strategy is strong. But the short term trading appeal seems limited. Unless one of those technical resistance levels gets decisively broken, maybe by an M&A announcement or something unexpected, near-term share price performance looks like it will be driven almost strictly by confirming that Q3 execution and hopefully successful pipeline news in December.
Okay, so what does this all mean for you? GSK offers the stability you'd expect from a top 5 pharma player plus a highly aggressive growth strategy. It's backed by cash flow, shareholder returns. But it absolutely requires patience. You need patience for the strategic benefits of that massive U.S. investment to really materialize fully.
And maybe here's a final provocative thought for you to consider. That massive $30 billion U.S. investment plan, it's designed to drive margin expansion and product velocity from 2027 onward. They're essentially trying to rebuild the plane while flying it. So the real long-term question for investors is probably this. Can GSK execute this complex, multi-year build-out fast enough to fully offset the revenue risks coming from those patent expiries late in the decade? That timing, the speed of execution versus the speed of expiration, that feels like the ultimate long-term variable here.
Fantastic analysis. Thanks for walking us through all the sources today. And remember, everyone, always explore your own sources before making any investment decisions. We'll catch you next time.